S. Krishnakumar, who is the director at Lion Hill Capital, to talk to us about markets and where he's seeing markets and trends headed. So, sir, if I can quickly ask you, how do you view markets at the moment? You're seeing the US 10-year bond yield retreat to 4.8. You're seeing positive global cues, but you're seeing the Indian index in retreat mode. How should one look at it?
Yeah. I think, in the near term, definitely the global construct isn't positive. Definitely, I think rising tensions in the Middle East is creating a lot of uncertainty on how this could go in the next 1 or 2 months. Also, the fact that the U.S. 10-year has been moving up and hitting a 5% and above kind of a mark definitely brings into focus the kind of stiff interest rates kind of ahead of us for the next 6 months and more. So with this kind of a situation, I think one would need to be a little bit cautious in the near term. However, the valuations basically which were quite stiff about some time back when we were closer to 20,000 in NIFTY is now a lot more comfortable within long-term averages about 18.2 times. However, the smaller and the microcap segments are running away at significant high valuations. So there is scope for correction across the board and more so in the lower end of the market. So, but I think, given the fact that India is one of the best stories in the next decade, one should continuously use the corrections in the market, over the next 3 to 6 months and get into the markets more at different levels. It's very difficult to time it. But I think given the uncertainty, we're headed down and we should try to kind of invest more into the markets on the way down.
Right. But, sir, if I can try and get more perspective on this, markets are forward-looking. There is a rate cut on the anvil in FY25, right? So we are a year away. We are very close to those peak rates. So what makes you skeptical at this point of time and what makes you feel that markets will correct at this point of time, given that India is also a sweet spot with regard to how the world GDP is placed versus India?
Yeah, as I mentioned, there is a lot of concern on markets from valuation perspective earlier and also on the bottom end of the market. Given the fact that globally things are uncertain, there is a tendency to be a little bit more cautious. As I said, however, we should use these sharp corrections in the market. If we have a 5-10% correction on the NIFTY and in the small and micro caps, I think one should start adding more to the assets. Basically, that's the view. So India definitely is a strong market to be in, and we will see a lot more positives over the next 2 to 3 years. However, I think given that we have had a poor monsoon and also the fact that we are running into elections and there could be some bit of uncertainty in the run-up to elections in terms of what kind of majority parties can get, I think there is definitely a bit of caution in the air that we should kind of be conscious of.
Understood. And how are you placed with regard to your current asset allocation? Are you more skewed towards debt? Because that's what I think you're leaning towards.
I think, when you have interest rates at where they are today and probably over the next 6 to 9 months, we don't have much of price in interest rate cuts. I think, there would be a fair bit of allocation that has shifted to debt instruments and given the kind of risk off globally, a bit of move into gold and other precious metals also happening at this point in time. However, I think, a substantial portion of our assets remain invested in equities and would get more allocation to equities on the way down for the next 5-10% in terms of stock price corrections, basically.
Right. So, it's no matter how bad markets get, it's always a good time to do bottom-up investing. Would you firstly agree with that? And secondly, I see a lot of sectors in the list that you've shared in terms of what your top picks are or what you would really look at if there were a correction. Why aren't something like a large cap banks part of that? Because what we've seen in terms of the returns of large cap banks as well as the manner in which they are placed valuation wise versus their 5-year averages looks very attractive.
Yeah. So I think from bank perspective, if you look at what's happened on the recovery, I think a lot of the benefits of the cleanup on the provision side and asset quality has been taken in by the markets. So a lot of re-rating of the banks in terms of stock prices has happened, and definitely we've had a good run on wealth creation there. So incrementally, what we are seeing here is the kind of benefits of 12 to 16% credit growth, depending upon which bank you're looking at, and also the fact that the spreads are getting compressed at this point in time with raising deposit costs, liability franchise, etc. I think you would definitely find that the growth basically from here on starts to kind of get to mid-teens, basically from a earnings perspective, from where they are at about 25-30% historically. So I think the best of the re-rating has happened, and I think we should just pencil in earnings growth as returns going for the large banks.
Right, and if the markets were to correct, what are the other sectors that you would look at? If I can just have your top 2 sectors you would look at if markets were to correct.
Yeah, I think industrials make a lot of sense, given that the government has been putting a lot of thrust on manufacturing in the country. I think you would see a lot of benefits that come to the capital goods and engineering space, broadly speaking, and the direct beneficiary of the schemes of the government are into manufacturing. There would be a strong growth revival in manufacturing and the contribution to GDP over the next decade. So we see these are the 2 big sectors that we would like to invest more in terms of manufacturing, from an engineering, industrial, capital goods space, in addition to the automobile ancillaries.
Right, and I also see one of your sectors being water treatment and green energy. That's it's more of a new age sector. What are the kind of names you're looking at in this sector, and what are the kind of valuations that you are really trying to or waiting for in terms of picking up some of the names in these sectors?
Yeah, so just avoiding the short names, but broadly speaking, water, capex and water chemicals, etc., are big areas, where there is a huge amount of growth that is kind of coming through. In addition to that, if you look at the green energy transition, basically, early times, people talk about hydrogen, etc. So a lot of global companies in India have their foot into those areas, and we should look at some of the Indian listed entities of global MNCs which have a lot of technology advancement in hydrogen and other solar areas. So that's the way we will look at this space from a longer term perspective. Valuations definitely are a little steep because you are factoring in a lot of the next decade and less of the current numbers, which are not as good as support the valuation. So one should definitely look at good entry points to get into some of these new trends, basically.
Right. Noted that one, but thank you so much. That's all the time we have, Mr. Krishnakumar. Need to slip into a very short break with markets, of course, reeling.